which then gets you to the idea of AI and what that's going to mean from both a productivity enhancement and potentially as a sort of a deflationary aspect as well. But I'm curious how you think about the advent, particularly of generative AI of late, in your business and throughout the corporate world.
Well, I think AI will be will totally transform the business world, the corporate world. If you intersect AI with improved sensor technology, in addition to that, to improved robotics, it's not only going to transform the business side, the back office, it's going to transform how we manufacture. And BlackRock started our AI lab in 2018 at Stanford University. It has really helped us improve. Some of our active growth is in our systematic equity team that uses AI, and our performance over 10 years is about 93% above the consistent performance. We believe that AI will transform how we think, how we invest. Data retrieval, information retrieval will be essential. We are using AI to revolutionize our Aladdin system that we provide our technology system to so many people. So I'm so neurotic about AI. I think AI is going to transcend.
Well, when you say neurotic, is it both a concern or just that you're not using it as effectively as you could? Or
all of the above.
What does that mean? What's your neurosis based on?
Neuroses, are we moving fast enough? Are we cautious enough? Are we making sure we have the structure in place to make sure we could utilize it properly? Are we focusing on how we could use new technologies in AI to improve the workforce at BlackRock and improve how we work with our clients, and how do we build deeper, better relationships? It's a very complex issue. I also believe we're going to be using AI to transcend how we live. I mean, Elon Musk, you were talking about earlier about robo-taxis. I mean, if you think about an automobile, it's a very expensive capital expenditure for something to use for 10 hours a week. And if there is an advancement towards more and more robo-taxis in cities, think about that. If you don't have to put all that money down on owning a car, more people probably could own a home. There's so many wonderful transformations in society that technology is going to do to improve most people's quality of life. I was with a CEO earlier this week, and this CEO said to me, we are going to use more technology than ever before. And it means as we grow our business, as a percent of our business, we'll have fewer human beings as a percent of our business, but each employee will have higher wages.
Right.
So you're going to be able to do that. And look at BlackRock and our earnings. We've raised assets over $1.5 trillion in the last 18 months and did not add a job. That is productivity.
Although, man, all those people who may not be working, and maybe we have to, I don't know what we do for them. And by the way, what about their retirement savings, which you spent a lot of time in your letter on recently talking about and being concerned about, again, to these transformational changes you're talking about.
But they're going to create new jobs, too. Think about all the needs for building out data centers and management. It's going to reshape our jobs. Let's be clear. Think about all the jobs that have been lost in society, whether telephone operators, even from, there's so many jobs that have been eliminated, but we have 3.7 unemployment. Over time, we create new jobs, and unfortunately, there's a timing differential, and in many cases, a geographic differential. But look, between decarbonization, between what we're doing in our own country related to hydrocarbons. Think about, we went from 8 million barrels of energy in the United States to 13 million barrels of energy, all on new technology. So we're not focusing on how technology has reshaped even something like energy extraction, energy identification. And it's going to be the same technological transformation that is going to build other industries into new jobs, new job creations. And so I actually believe we should be enthusiastic and front-centered on it. And I do believe this is what's going to be leading the United States to be the strongest economy in the world.
I just want to ask you finally about China, because I was there this week, and while you're thinking about big picture investment themes, there are some serious questions about where the geopolitics go between the U.S. and China, and where the economic growth comes from in China and whether we've seen the peak. How are you thinking about it?
So, getting back to my chairman's letter, I talk about hope and fear. I think the biggest fundamental undiscussed question about China is the fear within China. We're spending so much time talking about imports, exports. China right now is a 35% savings rate, the highest savings rate in the world. And and most of that savings rate because they're frightened of the real estate market now. They don't have a retirement system. They don't have a healthcare system. And so the savings rates are extraordinarily high. They're not consuming. And so China, knowing that they don't have a strong domestic economy, is trying to export its way out of its problem. And that remains to be a problem. And if you look at, in most advanced economies, the domestic consumption is generally 70+% of GDP. In China, it's 30%, and most of it is export. And there lies a paradigm problem between the world and China and the world. China needs to develop more hope within its country, more opportunity in that country, and so that's the statistic I look at. What is a savings rate? It's a pretty simple thing to look at. And if the savings rates go lower and they're starting to consume more, that's a good outcome. But during COVID, actually in China, because of the behaviors of China and the lockdown, savings rates in China was 50% of disposable income. Okay, that's not a good thing. And that's why we need to focus on these simple concepts of hope and fear and then translating that to savings rates. And in China, that is the most important statistic to look at. Whether they can find different places to export, that's going to be a big question. But I think Secretary Yellen said some very appropriate issues related to if China is not going to be able to export its problem out of it, it's going to have to advance its own economy. And let's see how that plays out.
Larry, thank you for being here, for stopping by. Appreciate it as always.
Good to be here.
Larry Fink, the chairman and CEO of BlackRock.
Speaking of China, it's certainly a topic for our next conversation, an exclusive interview coming up with Nike CEO John Donahoe in the next hour. Before we head to break, let's quickly hit the bond report, show you what treasuries are doing. There's a bid today for our bonds, which is a reverse of what we've seen for the past few weeks. 10-year note yield, though, remains above 4.5%, so elevated, even though they're getting bought with lower yields today. We'll be right back.
to learn more.
Top Amazon executive says it is a myth that robots and other technologies take jobs away from people. Take a listen to what the company's director of global robotics told CNBC Europe yesterday.
It is a myth that technology and robots take out jobs. The number you mentioned is already a demonstration of that, because robots and technology help our employees. For example, by reducing walking distance between assignments, by taking away repetitive motion, or by helping them to lift heavy weight. And in turn, our employees can learn new skills. They can learn new competencies, acquire new capabilities that allow them to progress towards their career objectives.
Hundreds of thousands of people obviously employed in distribution centers owned by Amazon.
I was going to say, well, they have, I think, 750,000 robots and 1.5 million people. So that jives with what he says.
Yeah.
Right, and I mean, it takes away jobs from certain specific people, but I mean, look, the auto plants, integrated robotics decades ago, right? And
Yeah.
it's sort of a supplement.
Yeah, we'll be curious to see what it looks like. But they are adding more and more robotics all the time in distribution centers. So two positive takes, at least, on the coming of advancement of technology. Larry Fink also saying AI won't take jobs as well.
Yeah. Productivity.
Yeah.
People will make more and do more things.
You want to be on the right side of the robots when they start to take over.
I'm all with you. I know. I don't know where I'm going. Once they have general artificial intelligence in the robots that exceeds our own,
but can they have your hair?
Still concerned. No.
We all have to know what our edge is.
The answer is no. All right.
Mine?
She went with the hair, not the mind. Coming up, an exclusive, Nike CEO John Donahoe is going to be a guest on Squawk on the Street. Don't go anywhere.
Friday morning. Welcome to another hour of Squawk on the Street. I'm Sarah Eisen here with David Faber live, as always, at Post 9 of the New York Stock Exchange. Carl's on assignment. Take a look at stocks. We are lower today, but we've paired some of the early losses. The Dow's down about 228 points. S&P down 0.6%. We're negative for the week, down 0.7 for the week, but the NASDAQ is actually up for the week, 0.5%, even though today's fall is pretty sharp. A lot of the tech winners from yesterday giving back their gains. Broadcom, NVIDIA, AMD, Microsoft, Meta, all lagging today. Apple's up again after a 4% up day. Alphabet is also higher in today's session. Take a look at treasuries. They're also going the other way. It's been a trend of higher yields. Today it's lower yields, although the 10-year remains above 4.5%. There's buying today, potentially on this jump in crude oil. Brent crude, 91.73. Geopolitical tensions front and center. Gold is higher again. It's been up for several weeks in a row. We're 30 minutes here into the trading session. We're going to get to the banks in just a moment. Here's some other movers we're watching. Semiconductors under pressure. Following reports, China is telling the country's biggest telecom carriers to phase out foreign chips that are important to their networks. The move could impact the likes of Intel and AMD in particular. Apple's trying to build on yesterday's big gains, as mentioned, coming off its best day in nearly a year, but shares are still negative for the year. Goldman out with a new note reiterating a buy rating, expecting the company to deliver on upcoming earnings. And then Tesla, another tech stock that's been struggling this year. Citigroup lowering its price target to $180 per share from $196, saying analysts there still see more downside than upside ahead due to demand headwinds. We do have some breaking economic data crossing the tape. This is University of Michigan consumer sentiment data, and it is a miss, 77.9. The estimate was around 79.9. Breaking it out a little bit, year-ahead inflation expectations, which we know the Fed watches, they ticked up to 2.9% last month. From 2.9% to 3.1% this month. You never want to see that number go in a higher direction. Although when it comes to consumer inflation expectations, a lot of it is influenced by energy prices, and oil prices have been moving up. You see that at the gas pumps, and that's been a problem and has fed into the inflationary worry lately. And that's where we begin. This is a week where, January and February hotter inflation numbers were taken as, okay, there's some seasonal issues. Let's wait for March. Well, we got the March CPI, and it was disappointingly high. And that has led to a complete rethink on Wall Street about how many Fed cuts we're going to get, whether we're even going to get Fed cuts this year. You just heard from Larry Fink, the head of BlackRock. He was on with us. He's been saying for a while inflation's going to remain sticky. Here's what he says now about the prospect of getting back to the Fed's target.
I think 2 is a hard number. We have restructured how we frame our economic policy. We have $1 trillion of fiscal stimulus in the CHIPS Act, the Infrastructure Act, and the IRA. We have very poor legal immigration policies that have restricted, and that is all inflationary in jobs. And then the bigger issue is how we think about how we spend our incremental dollars. As we're spending a lot more money on services. So if you think about where service inflation is really the main culprit of high elevated inflation. We have an aging housing stock in America. So our homes have more frequency of leaks from older roofs. We have more frequency of busted pipes. This is now translating into a higher elevated insurance cost.
And we did see the insurance costs rise significantly in the CPI.
Yeah, he did hit that, and he hit auto insurance as well. Talking about that, of course, one day you could imagine perhaps that will start going down. As I said, I didn't think we'd get to busted pipes when we were talking to Larry Fink there, but that's where he went.
Brought it all home. 22% rise in car insurance was what we saw for the month of March, and he attributes that to increased crashes and safety issues. And some would say, well, the Fed can't do anything about that, so why not cut rates? Interestingly, Fink also said that he saw the ability of the Fed to cut rates about 2 times. Mm-hmm. And so now the market's wondering, okay, are we going to get 1? Are we going to get 2? Are we going to get 3? Boston Fed President Susan Collins was on the wires, made some news. She's not a voter this year, but she did say, I am still expecting that we're going to see some slowing in demand start and continue into 2024, and that will help bring inflation down later in the year. I am in the range of 2 expected rate cuts. So there's still plenty of members of the Fed, David, that are worried about the economy, and they want to get out in front of any slowdown.
2%. It's why is that always the perfect number for inflation? And given what Larry was saying, Is there a day that we could imagine that at some point inflation or that number is moved up a bit?
It's a good debate to have, especially when you're talking about structural factors in the economy, like ESG, for instance. When everybody was ESG, they thought, oh, they should raise the inflation target because that's going to drive prices up across the board. The problem is, and the Fed can think about this, but they can't talk about it because then it'll hurt their credibility on getting back to their inflation target. And, you know, as Mike pointed out, we're not too far away. If you look at their preferred measure of the PCE, it's in the 2.8 range, so it's not too far off. The Fed is talking about cutting rates before it gets to 2%, so it's basically accepting that it doesn't have to be all the way there. So it doesn't really matter if they raise their inflation target in the long term because of structural factors, as long as they don't end up in a situation where they're cutting rates and then inflation flares back up and goes back, say, above 3%. That would be the worst from a credibility standpoint. So all the banks are weighing in. Bank of America says don't expect anything now till December, following another upside surprise to inflation in March. Fed cuts will start in December rather than June. Furthermore, we expect 425 cuts in 2025 and then another 2 in 2026. Risks are skewed toward a later start to rate cuts, particularly if housing inflation remains sticky. And that has been one of the points. Deutsche Bank also goes to December. One rate cut this year at the December meeting, followed by modest further reductions in 2025. Beyond next year, we expect the Fed to guide the policy rate back toward a neutral level that is likely just below 4% by the end of 2026. So now we're into 2025 rate cut expectations. And the question is the market going to be okay with it? Because can the economy hold up without rate cuts?
Right. And as for the broader equity markets, of course, they've been sort of trying to weigh this to the point of your debate with Mike in terms of the influence of rate policy on equities. It would certainly prove your point this week, and perhaps given the weakness we've seen to a certain extent. But the economy is strong, and therefore, as we move into earnings season, the expectations are we will see fairly strong reports and or the possibility of decent guidance. Although then I come back to so many of the things you share with us from the conference calls from last quarter, Sarah.
Uncertainty.
That is a lot of uncertainty.
It depends what industry you're in. The economy is not strong if you're in some parts of retail that cater to the low-income consumer, or if you're in electronics, or these categories, if you're in housing, household products. And these are deflationary goods categories. It really is in the services sector that has been strong. It also, we get into now, we're talking about rate cut timing, we get into the election. And Bank of America, I thought, had a great chart. It's a flow chart, so it shows probabilities based on current readings of CPI that I decided to make for us, because it showed that we could be on trend for 4 to 5% inflation year over year by the election time if we continue to get readings like we have gotten, the 0.3% monthly gains on inflation. That could be a big problem for President Biden. Even with the disinflation last year, people were still feeling the cumulative impact. Now, if we start to go back up and see these stickier prices, what's happening with gas prices, not great. No. Also not a great look for the Fed to start cutting in September.
Right before an election. All good points. All right, we've started earnings season. In fact, it does kick off with the banks. Leslie Picker's monitoring the conference calls. Leslie, if I could just come to you on J.P. Morgan, perhaps you were going to start there anyway. I did note that stock is down almost 5%. Not quite sure exactly what it is they said on the call, but certainly curious to hear your reporting.
Yeah, David, I saw a headline that's the worst open for J.P. Morgan shares since March of 2023, which I would imagine was dragged down due to the regional bank turmoil and concerns about contagion therein. So pretty notable there, 4.6% decline right now. Those shares under pressure after the firm guidance showed slightly higher expenses and net interest income for the year. The firm saying NII, the profitability metric for loan making, will be $89 billion, boosted by $1 billion from prior guidance given in January. And analysts call that a moderate disappointment given the rate environment appeared to have grown more favorable for some of the large banks, including J.P. Morgan. Now, Chairman and CEO Jamie Dimon addressing the macro environment on the firm's analyst call, which ended a short while ago in response to a question about the health of the commercial real estate environment, a subject very well covered on this show. Dimon said rising rates, particularly if the 10-year were to go up to 2% more, assets would be worth about 1/5 less, and that could put strain on the system.
interest rates are important. The recession's important. If things stay where they are today, we have kind of the soft landing that seems to be embedded in the marketplace. The real estate will muddle through. Obviously it'd be idiosyncratic if you're in different cities and, different types and B versus A buildings and all that, but, people will muddle through. They won't muddle through under higher rates with the recession. That would be tough for a lot of folks and not just real estate, if in fact that happens.
JP Morgan CFO Jeremy Barnum also addressing commercial real estate on a media call earlier today where he said, quote, "There's no light at the end of the tunnel there." The firm reported $144 billion in commercial real estate loans at quarter end, guys. But David, to your question about why the stock is falling, I think it's largely on that guidance, which disappointed Wall Street, which was expecting more of an increase to the full year net interest income outlook for 2024.
All right, we're going to find out even more about that, Leslie. Thank you, Leslie Picker. Let's continue the conversation with UBS bank analyst Erica Najarian. She has a buy on JP Morgan and Wells Fargo, a neutral rating on Citi. So let's just start there. Is that your take as well? Was it the guidance number? I mean, it's unusual to see JP Morgan shares down as much as 5% in the early going after earnings, Erica.
Yeah, absolutely. The street really went there in terms of how they were thinking about the revisions to net interest income, or NII. Keep in mind that JP Morgan and the other money center banks are asset sensitive. So the more cuts you take out of the forward curve, the more they theoretically earn. So the 89 billion number that was mentioned in the earlier bit, I think the street was already, above 90 for that metric. And so the 89 was a bit of a disappointment. And also when asked, if we took out the 3 rate cuts that were embedded in, their guidance for the 89, what difference would that make? And we didn't really get a strong answer, a firm answer for JP Morgan. So I think that's really a big part of the disappointment.
So part of it is simply the fact that we very well may not get 3 rate cuts this year and not getting a clear answer, I guess, in terms of what impact that's going to have on the bank.
Yeah, absolutely. And the other thing, too, is, the provision is going to go up from consensus estimates. Those are, those are credit costs related to better credit card growth. The tax rate was higher. Expenses were a little bit higher because of the FDIC. So net, the stock is ripped into the print, and now you're not going to get a consequent EPS upgrade. I think that's why the stock is taking quite a breather here today.
What about Wells Fargo? You seem more impressed with the number, although I don't think they upgraded net interest income based on Fed path either.
They didn't, but their fee number was quite the blowout. So, you're looking closely to see if there were any sort of one-time idiosyncrasies in terms of what caused that blowout to consensus. But really what was happening there is they earned more in trading, they earned more in investment banking, and they just had overall strength in that line. And I think that's really, really important for the long-only narrative, the long-term shareholder narrative to the stock, right? Because, clearly Wells Fargo is a fixer-upper, so to speak, as they deal with the regulatory issues. And I think that beat in the fee revenue item essentially told the street, look, they were not just cutting costs, but they were cutting costs overall, but using some of those cost savings to invest back into the business. And as for net interest income, Sarah, I think it's too early for Wells Fargo to upgrade their NII guidance. So I think it's still potentially on the come, but JP Morgan not upgrading their NII guidance today makes me less confident that it is to come for Wells Fargo in the future.
We have the Wells Fargo CFO on the next hour, and we'll talk to him about this. But just on the expense side, I think it was a miss on Wells Fargo, and they reiterated the long-term expense guide. I know that's been important for investors who are long this stock. What did we learn about expenses, both there and at some of the competitors?
Yeah, I think there's not really anything to report. Usually the first quarter is seasonally higher. And for JP Morgan, which was impacted by the FDIC, but for Wells and for Citi, they're really reiterating the core expense run rate. So nothing much to report there, as other than the first quarter is typically seasonally higher.
Finally, Erica, the Citi, which as a stock at least has outperformed many of its peers, something I can't remember it having done for years, at least during the first quarter. Did this quarter report do enough to continue that momentum?
I think for now, yeah, sure. I'm a little bit of a Citi skeptic given the history, and many of us analysts have been burned having buy ratings on that stock, being in love with just the multiple. But I'll tell you what, I think that Citi is truly making good progress. Like Sarah mentioned, expenses are still in line with what they're guiding for the year. And really becoming a more efficient company is critical for that stock to continue to do well. I think looking forward from here, there's a lot of skepticism about whether or not they can hit the revenue target of 80 to 81 billion, which they did reiterate today, just because it's impossible for me to believe that you can cut expenses as a bank in a commoditized business and also grow revenues without rate tailwinds. That being said, I think a critical catalyst beyond today for Citigroup are the stress test results in June. If they can buy back more than 500 million, which is what they did this quarter, then that stock can maybe really start working for real and get long-only investors from the sidelines. Because buying back the stock at that kind of discount to tangible book value is very, very powerful in terms of what that could mean for tangible book value accretion.
Great, something for us to keep in mind as we head to June. Erica, always appreciate it. Thank you.
Thank you.
As we head to break, here's our roadmap for you for the rest of the hour. Wild week for stocks and bonds. How to position your portfolio from here as we head into next week's flood of earnings.
Plus, always some big moves in technology. Apple, for example, those shares coming off the best day in almost a year. Amazon's at all-time highs. And we got a number of street calls that you need to know about.
And a rare exclusive with Nike CEO John Donahoe on his preparations for the Paris Olympics, the health of retail and the consumer, and much more. Big show still ahead. Squawk on the Street. We'll be right back after a quick break. Stocks sliding again here as investors digest this morning's batch of bank earnings. The Dow and the S&P both on pace for their second negative week in a row. The 10-year just shy of its highest levels of the year. The Nasdaq actually is higher for the week. Joining us now is Crossmark Global Investment CEO and CIO Bob Dahl. And I do wonder if there's some sort of gold's up, oil's up, dollar's up. commodities and tech, and what that tells you happened this week.
Well, I think what it's saying, Sarah, is the economy is okay. Inflation is not. That is, it's too stubborn. You covered that well here in the first 2 minutes. That means less rate cuts. That's not good for valuations. Stocks selling at 21.5 times are assuming that the Fed was going to cut rates at the beginning of the year 6 times, and then it was 4, and then 3, and now it's 2, maybe not at all. I think we will also have some question marks about earnings, Sarah. The 11% this year, 13% next year. They're big numbers without coming off some depressed level from a recession. And first quarter analysts are only expecting 5% gain. How are we going to get 11 for the full year? So I'm a little concerned with all the cross currents.
You remind me, you've been pretty cautious. You were cautious coming into this year, right? And
cautious too soon, yes.
The gains that we've had so far this year, I guess you still think that we're heading for a challenging period?
Yeah, it's, when the PE is over 20, things better be nearly perfect. And when you're not getting the rate cuts, you can't sustain the PE. And then if earnings become a question mark, that will cause a lot more people to ask questions.
Why do you think earnings will become a question mark if the economic data continues to surprise mostly in a better place?
Well, let's look at the evidence. First quarter pre-releases, the percentage that were negative were the highest in 5 years. Companies are struggling to raise prices as much as they were earlier. Consumers are beginning to balk at that, and they're still having cost pressures, whether it's labor or, as you mentioned, raw materials. So I think we'll have some profit issues as the year transpires.
All right. So what do you like, if anything, Bob, given the rest of the year is ahead of us?
Right. I mean, a lot of portfolios, my long-onlys are fully invested. I'm really focusing on some common factors. That is, companies with high earnings predictability, high earnings persistence, strong free cash flow. Those stocks have done just fine as the market's gone up. I think they will show some defensive characteristics if the market has further slippage here in the next weeks.
Okay, Bob. Thanks for checking in. Appreciate it. After a bumpy ride this week, we're down 0.75% right now on the S&P, almost a full percent for the week. Bob Dahl.
All right, as we head to break, let's give you a look at the biggest gainers on the S&P for the week. There's that GE Vernova, of course, a recent spinoff from GE Aerospace. Everything now trades independently. You can see it's had a very strong week. Joined there by, at the bottom, Palo Alto and First Solar. We're back in 2. CNBC and the NRF out with some new data on the consumer. Steve Leisman's here. He's got the exclusive results. Steve.
Good morning, David. Yeah, consumers continued moderately strong spending in March, spending that looks even a little bit better when you consider that inflation in the consumer goods sector, apart from the overall number, is flat and even negative in certain categories. The CNBC NRF retail monitor for March, which is powered by real credit card spending data from Affinity Solutions, shows retail sales ex auto and gas up 0.4 compared to 0.4 in February. That is a February, by the way. We removed the leap day for comparison purposes. Taking out, look at the year over year, it's 2.7 versus 2.7. And then you take out restaurants for the core retail number, 0.2. Actually, it's down less than a tenth. It's 0.23 versus 0.27. It's the rounding that looks like it's a 10th decline, but a 10th decline on the year over year, 2.9 versus 3% in February, again, adjusted to remove the leap day. The history shows considerable volatility over the past several months, but spending has now bounced back into this positive territory for 2 months in a row after the January decline. Some had wondered whether we were seeing the beginning of the long-awaited consumer slowdown. Still waiting for that because we have good numbers again. So the breakdown by sector, evenly mixed results, 6 up, 6 down. Here are the top and bottom three. Non-store retailers, you push in there, that's your internet number, up strong. Food and beverages up strong as well. And sporting goods and hobbies up almost a percentage point. That's good because that's really a discretionary area. But the two next sectors, the big negatives, again, those are connected, what we've seen continuously, to the home building sectors. Appliances also, those prices have come down, so there could be some deflation in the electronics and appliances, as well as an impact on the housing market, despite higher overall inflation, which we reported in the market and rocked the market early this week. Goods inflation has been flat to negative in 8 of the past 12 months. That suggests consumers are looking for value, and it's a competitive market. That's according to the NRF. Government reporting this morning that prices for consumer goods imports, taking out autos, actually fell in March, and yesterday's wholesale price report showed just a 0.1% increase for consumer goods prices. That should be good news for retail margins, even with a consumer looking for value and a competitive market. But of course, there are those challenges, guys, from high labor costs that we have to watch out for when it comes to margins. Sarah, I don't know what you're hearing from your retail contacts when it comes to the margins, but at least the input costs seem to be well controlled on the goods side.
Yeah, they're getting that tailwind from lower input costs and lower freight costs on one hand, but apparel prices not getting a ton of pricing power, right? That's been a weaker category.
Yeah, actually, it was anomalously up in the last report, kind of like an eye popper on this. I think it was a 0.7 increase on apparel price. We'll have to see if that's a trend. But I am interested in how some of these minimum wage increases feed through to the bottom line. I did get a note from Matt Shea from the NRF who said to me, see, Steve, there is not price gouging going on in the retail business. And I think that may be accurate given what's happened. We'll see if those profit margins remain relatively stable or if they come down even a little bit, given that they had increased during the prior 2 years.
And everybody's doing a little productivity savings, too, which could help margins. Thank you, Steve.
Thanks.
Steve Leisman, really interesting take there on the consumer. After the break, speaking of, don't miss our exclusive with the CEO of Nike, live from Paris, unveiling new uniforms for the Summer Olympics. We'll be right back.
Welcome back to Squawk on the Street. I'm Bertha Coombs with your CNBC News Update. The U.S. is restricting travel for its staff in Israel as Tel Aviv reportedly prepares for an Iranian attack this weekend. The security alert restricts U.S. employees and their family members from personal travel in certain parts of Israel out of an abundance of caution. India, France, and other countries have issued similar warnings to their citizens. Russia is reviewing a peace proposal from 2022 that Ukraine had previously rejected. The Kremlin said today that the draft agreement could serve as a starting point for talks to end the war. Russia has dismissed Ukraine's proposal, which demands for Moscow to pull back its troops, compensate Ukraine, and face an international tribunal. President Biden announced another round of student debt forgiveness this morning. He said today his administration will cancel $7.4 billion in loans for 277,000 borrowers in certain low-income programs. With this latest move, the White House says it has now canceled $153 billion in loans for 4.3 million Americans. Sarah, back over to you.
Okay, Bertha, thank you very much. We're about an hour here into trading. Just want to show you what's happening in the market. We've turned south again. The Dow's down 321 points. The banks are definitely part of that story, with JP Morgan the biggest drag off earnings. Goldman Sachs right down there with it. Microsoft is getting hit, so technology giving back a lot of yesterday's gains. The only two sectors that are working today are energy and utilities. Oil prices marching higher on these increased geopolitical fears around a potential Iranian attack on Israel. Brent crude above $91 per barrel. Gold's higher again. You also see that geopolitical tension reflected there. And the U.S. dollar continues to march higher. It's had a very strong week, up almost 1.7% on stickier inflation. The Summer Olympics are just over 3 months away. While Paris is preparing for the games, so are major sponsors like Nike, unveiling its new uniforms for teams and athletes, Team USA and others, from running to breakdancing. CEO John Donahoe joins me now to discuss his outlook for the Summer Games and the company as a whole. John, welcome. Good to see you in Paris this morning.
Great to see you, Sarah.
So tell us what's new and different about this Olympics unveil.
Well, as you mentioned, I'm here in Paris, and we're in this very venue last night. We unveiled a major multi-year innovation cycle. And we did it in a way only Nike can, with the world's greatest athletes on what is the biggest stage in sport, the Summer Games. And I tell you, I wish you could have been here, Sarah, because it was remarkable. We had 40 of the greatest athletes in the world, ranging from four-time medalist Eliud Kipchoge